Let's have a look at the oil sector and the basics of how it works. Before jumping into the graph, we have to keep in mind that oil is a commodity. The only thing a company can do to improve is to have a lower extraction cost. There is no value added, like for example in the automobile industry, where a luxury car will be more expensive and customers might be willing to pay an extra for the added value. In the oil sector, even if there are different qualities of oil, companies can't control the quality of the oil extracted, but they can control the cost of extraction. So, why is it important to stay in producers with the lowest costs? This is due to the cycles of the business. In some periods of the time where we might be an oversupply of oil in the market, which will drive prices lower. In such a scenario, all oil companies will start to go bankrupt, or at least they will start to invest less money in new productions. And less production will be translated in higher prices at some point. So a company producing at low cost will allow them to have like a better margins and resist in the low prices scenarios. Let's jump into the first graph, and we will see the price evolution of oil. And on the second one, I adjusted the price to the US inflation. In the oil sector, the cycles of the business are marked by the supply and demand. As an investor, you always want to enter in the lowest moment of the cycles, when the sector is suffering and everybody tries to avoid the oil market. And how can we identify the cycles? Since we are talking about a commodity, we just have to look at the price. We should also keep in mind that over time, cost of extraction gets higher and higher. Most of the lower extraction cost oil fields have already been exploited, so little by little prices of oil get more and more costly. There is only one exception to this is during a technological disruption. This is the case, for example, of 2015, when fracking became commercially profitable and the extraction of existing oil fields became cheaper. Here, I just added a chart with the world production of oil, where we can observe that even if there is a big expansion of renewables, the technology now makes them profitable and everything. Oil is still very relevant and increasing the demand year after year. We can just see like a low in the COVID, but other than that, it's just still increasing. In the next page, I added the world energy production by source. Keep in mind that oil is not that common anymore for electricity generation, but it's still very important for transportation and industrial processing of raw materials. To end, we can look at the actual scenario and what could affect the oil prices in the short term. In the first step, I added the oil stocks. This is important because we have seen in the past countries using the stock reserves to push prices in different directions. I could find the information easily for the US in the Energy Information Administration, but for the worldwide reserves, I could only find some estimates. The US chart is showing a strong decline of stocks since 2020. That was mainly driven by the decrease of the strategic reserves. And at first, it might seem that the US might need to replenish stocks, but we have to keep in mind that the US used to be an importer of oil, and thanks to fracking is now an exporter. So they are not dependent anymore in oil reserves. Additionally, we look at the world reserves, we see in comparison that in comparison to last year, that the US has still increased the stocks by 40 million barrels, China by 100, and oil in water, which is the oil that is in transit from one port to another has also increased around 250 million barrels. The reason of that increase in the oil in water might be the difficulties that might see the Russian dark fleet to sell the oil into the market. In the Iran war, an estimate of 15 million barrels per day might be blocked, but we already came from an oversupply of around 3 million barrels per day. And in March 11, the 32 members of the EIA agreed to release around 400 million barrels of oil. This could cover the deficit of oil for a little bit more than a month, and effective from 12 to March, 12 March to the 11th of April, the US will also allow for the sale of Russian oil and petroleum products that were already loaded into vessels. This means that the increase seen in the oil in water might be able to sell the oil that they are carrying, and this could cover the deficit if we take in account that most of the dark fleet is able to sell the oil. This could cover around 14 days of oil deficit. With this said, we don't really know the length of this conflict, and if this is resolved quickly, we might see the normalization of prices and prices going definitely lower. But if the war takes long, we cannot imagine that even with release of stocks, they could cover the deficit for long periods of time, like for example could be a year or something like this. Thank you very much for seeing this video, and see you on the next one.